Hey everyone, in this video we're going to go over Verizon stock and decide if it's a cheap stock at these prices or if it's just a value trap. Now before we get into it, if you could smash the like button and subscribe, it really helps the YouTube algorithm. Thank you. Now let's get into it. As of yesterday's close, Verizon stopped trading at $35.14, down 30.4% on the year. Now, Verizon has had a rough year, with its 52-week high being $51.36. And obviously, as interest rates went up, the stock for Verizon as a utility has went down. We'll get into that, and that's one of many reasons why Verizon has been struggling recently. Now, it's important to note the market cap of Verizon is $147 billion, but their enterprise value is actually $302 billion, which is down from around $360 billion a year ago. So Verizon does have a ton of debt. It is down overall, but it has a lot of debt. That's the difference between the market cap and the enterprise value, is adding in what cash it has, which is very little, around $2 billion or so, and all the debt it has, which is extremely a lot, over $150 billion. Now, it's not uncommon for a utility stock to have a lot of debt, and that's why we typically see utility stocks go down when interest rates go up, because their interest expense is going higher as these interest rates go up. Now, when looking at the first 3 months of the year, ending March 31st, 23, we saw in that quarterly report that total operating revenue was roughly flat. It was down just under 2% from a year before. We saw the total operating expenses was roughly flat as well, down 1.7%. Now, when we looked at the operating income, it was down 2.7% year over year. So, calling it roughly flat, in line with what happened with operating expenses and operating revenue. But in the other income categories, where we really saw a big difference that mattered for the bottom line. In other income for this quarter, there was a positive $114 million that went to the bottom line, whereas a year ago in the same quarter, there was a loss of $924 million, which is a huge difference. We're talking about $1 billion difference, basically. Now, if you get rid of the other category and you disregard that income, not that you should, but if you did and just looked at the operating business itself and what it brings to the bottom line, you'd have $4.9 billion versus $5.6 billion last year. So you would have a considerable drop rather than a small increase year over year on the net income level. Now, the last thing to look at is the interest expense before we get to the net income. In the operating income breakdown, we do see that they have an interest expense of $1.2 billion for the first quarter. And that's a lot higher than the $786 million of interest expense we had a year ago in the same quarter. We saw a 53.6% increase in their interest expense. So that's a massive increase, and that's obviously hurting the bottom line. So let's look at this. Even with the interest payments, Verizon brings in around $5 billion a quarter, or $20 billion a year in net income. And they have a market cap of $147 billion. Now, that $20 billion a year they're bringing in is already after they're paying their interest on the debt they have, so it's accounted for. This means that Verizon is only trading for around 7 times earnings, and that is undoubtedly cheap. If you look, the PE ratio for Verizon has averaged at 13.66 over the last 10 years. The current PE ratio, like I said, is around 7 times earnings, so it's about 50% lower than historical average. Now, all that said, over the last 10 years, we've had a lot lower interest rates, close to zero interest rates, for a long time. So going forward, how Verizon, as they have to issue new debt and get rid of past debt, how will their net income change over time is something that's really important to keep an eye on. Now, dividends are great. It's always nice to have some cash flow coming back into your account or going back into buying more stock. And by buying Verizon today, you're getting a dividend yield of 7.43% on the money you're investing. It is important to understand that a dividend yield is not something that is in addition to their net income. If a company pays a dividend, it doesn't have that cash on hand anymore. And when another company, for example, is not paying a dividend, that cash is just sitting in their bank account, or they could be using it for buybacks. And all of these things help shareholders in a different way, because if Verizon stopped paying a dividend, it would have that cash to use to pay more debt off. It could use that cash to just sit in the bank account, and now theoretically, the stock price should reflect that and be higher because its assets, its cash on hand, is higher and its balance sheet would be better. All of that said, utility companies like to pay a high dividend because that's the type of investor they're attracting. An investor that wants to have cash flow coming back to them. So rather than getting as much share appreciation over time as other companies, you're getting a lot of that appreciation. In this scenario, half of it, because the payout ratio is 50%, being given back to you. So, theoretically, if the stock should be going up around 14% every year, it's only going to go up around 7% because they're giving you the other 7%, assuming no other change. And when buying a stock for a dividend, it is important to check out the payout ratio because that will tell you if they can afford to pay it. They're paying out 50% of what they're making in a dividend. This allows them to use the other 50% to do things like if they wanted buybacks. This allows them to pay down debt and have extra cash in the bank account, among other things. Now let's talk about competition. Risks from companies like SpaceX with Starlink could possess a really high threat to a company like Verizon over the long term, as they are trying to take internet and give it to everyone directly globally through space. Now, it's not as fast as internet on the ground right now, but if things changed over time, that is a long-term risk. On a more traditional level, competitors like AT&T and Tmobile, well, one, AT&T has negative net income right now. It does only have positive earnings before the interest, tax, depreciation, and amortization, where that interest expense is killing them. And T-Mobile is definitely, I think, a little more serious of a threat than AT&T is to Verizon, but it's, as an investment, trading at a P of 41. So it's extremely expensive to buy that stock. So if you're looking to add a cellular internet utility company to your portfolio, Verizon seems like the best one, in my opinion. Now the fun part. What is the stock worth? Well, I think a fair price is 10 times earnings. We know they do about $5 of earnings per share. So in a year, so 10 times 5 is $50 a share. And I think that's about a fair price. I think it's as simple as that. They should trade for about $50 a share, in my opinion, based on their business. And obviously, you have to keep an eye on that interest expense. You have to keep an eye on how the earnings per share is changing with each quarter. And you have to adjust this price target as things change. If interest starts to go up a lot higher and they're not making as much earnings, or their business starts to deteriorate, you have to change your multiple. You can, or keep your multiple, but to a new EPS, and see where it gets you. The thing is, the stock is currently trading at under $35 a share, which makes this a pretty attractive price point to buy into the stock, knowing that today, with today's numbers, it looks like it should be worth around $50 a share. Now, when looking at tip ranks, which has other analysts from different banks giving their ratings, we do see there are 4 buys, 8 holds, but 0 sells on Verizon. And the average price target over the next 12 months is $43.46, which represents about 24% upside. But we do have high price targets of $64 and a low price target of $37, which is also above today's price. We see that in the last 3 months, we had basically after that earnings report that we just went a little bit over, we had Goldman Sachs give a $41 price target, which is about 17% upside. JP Morgan also at $41. We had Raymond James at $51, a buy rating, 45% upside. UBS $60, buy rating 70.7% upside, and Deutsche Bank at $44 with a 25% upside. Now, if you enjoyed this video, smash the like button and subscribe, and make sure to comment below. Do you like Verizon stock? Also, which stocks are you interested in me doing a little deep dive analysis on for my next video? Until next time.